Berkshire Hathaway has been taken over by one of the world's finest investors, Mr. Warren Buffett, and the stock has averaged 20% annual return since then, which is double the S&P 500's annual return, giving Berkshire a total return of 2.8 million% over the S&P's relatively modest 23,000%. And he's done it by adhering to a simple set of rules that Warren Buffett's longtime business partner and Berkshire Hathaway Vice Chairman Charlie Munger summed up flawlessly, and that is, we must deal with things that we can comprehend. And once we've gotten through that, we must have a company with certain fundamental qualities that give it a long-term competitive advantage. Finally, we must have management in place with a high degree of integrity and competence. No item is worth an incessant price, no matter how brilliant it is. So given the natural commercial attitudes of life, we need pricing that makes sense and provides a margin of safety. It's a pretty simple set of principles, and that's why they haven't spread as quickly as they might. Charlie is correct. It's a straightforward 4-step process. I should also emphasize at the beginning of the video that this method remains constant regardless of market conditions. And in this video, we'll go through Warren Buffett's investment advice for 2022. It would mean the world if you'd subscribe. It's free of charge, and you can always change your mind later on. And that way, you can also easily be notified whenever we upload new videos on how to earn more money. So it's a win-win. With that said, let's continue. These 4 foundations of investment would never change. But by 2022, there's no denying that we'll be dealing with some challenging new issues in our investment. We're dealing with ridiculously overvalued stock markets, high inflation, and the likelihood of interest rate hikes this year as a result of that inflation. Let's start with the problem of overvalued stock markets and heed Warren Buffett's suggestions on each of these important factors. Let's start with the issue of inflated stock markets. When everything is so overpriced, how should we go about investing this year? If you're an active investor, odds are you won't have many opportunities to acquire inexpensive companies inside our sphere of influence this year. This is what Warren Buffett stated about in his annual letter to shareholders in 2019. He stated, "We hope to move most of our excess liquidity into companies that Berkshire will hold permanently in the years ahead." The immediate prospects for this, however, are not promising. Prices for companies with good long-term prospects are sky high right now. Yes, Buffett is attempting to acquire entire companies. We're only trying to buy a few shares, but at the end of the day, it's all the same. Nevertheless, without a doubt, he has had a difficult time finding somewhere to invest his money in the last year or two. He doesn't, however, simply lose money on expensive stocks. This is a grave investment sin. Instead, he just keeps accumulating money and waiting patiently. The cash on hand at Berkshire Hathaway has increased from $84.4 billion in Q3 of 2016 to $149.2 billion in Q3 of 2021. So it's far from ideal, but keep in mind that you gain money while you wait, not when you buy or sell. Wait for the right opportunities to present themselves and avoid buying average investments in an overpriced market, because as Warren Buffett points out, you only need a few terrific investments in your lifetime. Perhaps just be patient until the market provides you with one. So in 2022, that is the bitter reality of active investing. However, Buffett generally advocates another investing method for most people, which is, of course, passive investing. In addition, passive investors who are merely dollar cost averaging and investing in the stock market should continue to do so in 2022. It's not about investing at the right time for the passive investor. Rain, hail, or shine, the dollar cost averaging technique requires you to acquire market monitoring investments at the same time periods. You can get the market's average return by doing this for decades and decades. By the way, it's roughly 8% to 10% per year. So if you're a passive investor, don't worry about whether the market is high or low. Just keep going. Never read a headline. Never glance at a chart. Simply stick to your strategy. Have an ultra long-term mindset, and the stock market will be your ally. Even if you invested everything and the market plummeted 50% tomorrow, long-term passive investors would still be unbothered. It only took 5.5 years after the GFC, the world's largest economic crisis since the Great Depression, to get back to where you were. And 9 years later, the market has nearly tripled. So while the market is now high, it's not the end of the world. As active investors, we must be patient and avoid making rash decisions. We need to keep doing what we've always done and aim for that average. Before we proceed, please leave a comment below stating which country you're from so that we may create more customized content for your location. And now let's move on to inflation, which has been a big issue for the past year, and rightfully so. In the United States, yearly inflation has reached 6.8%, and inflation is expected to be a major concern in 2022 as well. According to Buffett, you can't just do one thing in economics. And then what? You must inquire. In his 1982 annual letter to shareholders, Warren Buffett outlined exactly what types of businesses we should be buying during periods of high inflation. So for starters, he's talking about companies that can raise prices without facing any penalties. That certainly helps to mitigate inflationary impacts. But what company could raise prices significantly without losing market share? People would almost certainly look for a cheaper product elsewhere. Not if you have a competitive advantage, at least. Apple constantly raises its prices higher than the competitors with little effect on their market share. People don't move to other drinks when Coca-Cola raises its costs, and they're two of Warren Buffett's biggest investments right now. During times of inflation, the most crucial thing to do is to make sure the companies you're considering have a competitive advantage. Something that implies that even if they raise their prices, they will keep their clients and consequently their market share. Second, according to Buffett, we need to look for businesses that can handle a large dollar volume rise with only modest additional capital investment. Basically, companies that can earn a lot more money without having to spend a lot of money to do so. This simply means that you should look for businesses with highly scalable business structures. Facebook doesn't need to create a new app solely to increase ad income. They can simply raise the frequency of their advertisements. But Ford must build more factories or recruit more staff to produce more cars, which is a considerably more difficult task. So in times of inflation, search for companies that have a competitive advantage and are easily scalable. Finally, let us discuss interest rates. The Federal Reserve has stated that it is considering 3 interest rate rises in 2022. Buffett explains why the market is currently so high. Because interest rates are at 0, major money managers can't make a profit on bonds. Therefore, the money they would have put into bonds finds its way into the stock market to chase profits, driving up values. That's the dynamic Buffett was referring to. Interest rates are what gravity is to matter in terms of stock market valuations. The easier it is to jump when gravity is low. However, increasing gravity makes it much more difficult. The stock market is the same way. We're currently experiencing ultra-low interest rates that signify stock market valuations can climb quickly. There is a lot of money streaming into the market right now, but in 2022, interest rates will begin to rise in the opposite way. The stronger gravity's pull becomes, the harder it is to jump as interest rates climb. While you should never let the macroeconomic situation influence your personal investing, it's worth remembering that values may come under pressure in 2022, 2023, and beyond, particularly for expensive equities, as new bonds become more appealing and interest rates rise. Thus, no economic Armageddon forecast, but be aware that it is a probability in the years ahead. Thank you for watching. I hope you gained some usable wisdom from this video. If you did, go ahead and hit the notification button and then subscribe to this channel. That way, you'll be updated anytime we upload life-changing videos like this one. Until next time, see ya!